Arbor Realty Trust currently offers a yield of 13% and is the most undervalued high-yield dividend-paying company, and one you should definitely consider for your portfolio. In today's episode, we're going to explain why it's significantly undervalued. We're going to take a look at the numbers, the top line revenue, as well as their bottom line net income. We're also going to review a quick health of the company, their total cash versus their total debt. And we'll also look at how they've performed versus others in this industry. Now, this is a mortgage REIT. We're also going to take a look at some insider buying, which we have noted, which is a very bullish signal from a director just a few weeks ago. As always, we will look at institutional ownership and what they have been doing quarter on quarter. We'll also talk about the borderline dividend safety score of 50 and why we don't believe right now it is a massive issue. And we'll take a few highlights from their latest presentation. Now, don't forget, we are going to get to the essential intrinsic value, why it is undervalued, showing our acceptable buy price, and what Wall Street expects over the next 12 months as a price target. Now, just to explain, this is a mortgage REIT. So for those that don't know, we start off with an equity REIT. So this is, for example, the likes of Realty Income, Vici Properties, where essentially shareholders here, they put money into a little pool, and then from that they buy property and then they rent it, and that essentially becomes the profit of the business. In terms of a mortgage REIT, a similar process where shareholders pool money. However, with this money, it is then loaned out as mortgages, and from that the profit is essentially the interest. So this is what we typically call an M REIT. Now, Arbor Realty, just looking at the historical performance, we can see it is up 21% over the last year, and over the last 10 years, it is up 88% or 87% in fact. But bear in mind, this doesn't include those dividends reinvested, so it would be significantly higher if you were to have reinvested them. And we can see all-time highs sitting around that $20 mark in October 2021. Currently, it is trading in the lower end or mid to lower end of the 52-week range. As we noted, a 13% yield and a forward PE sitting just above 9. Now, in terms of looking at the numbers, well, we can see total revenues, and typically we look for around 5 to 10% growth. $372 million in 2019, $719 million in December 2023. So what we can see here is, in fact, just under double growth over the period, which is very strong. On top of that, we see growth to 2020 and 2021 before a slight drop in 2022, and it picks up again in 2023. So overall, the top line, it is moving in the right direction, which is what we want to see with these M REITs. Now, bottom line net income, we also see the growth from $129 million in 2019 to $371 million in 2023. We also note, similar to the top line, there was growth up to 2021 before a slight drop, and then it did pick up. So although there is a little bit of an inconsistency, we note overall top line and bottom line growth is looking fairly strong. Now, as we generally do on these episodes, we have a quick look at the health of the company. Now, this is an M REIT, so slightly different, but nonetheless, we can still perform the same review. $300 million of cash and equivalents in December 2019, and we can see it has essentially tripled to $920 million in their latest report. When we compare that to the total debt, we can see that in actual fact it has increased from $4.7 billion in 2019 to $12.1 billion. But again, as an M REIT, this is something that is very typical and not a red flag indicator. In terms of performances, so we're just comparing it to a few in the mortgage REIT industry. We have Starwood Property, Rhythm Capital Corporation, and we have Blackstone Mortgage Trust. Now, over the last year, when we take a look, we can see this includes those dividends reinvested. ABR up 37%. Now, that is very strong, and in fact, it is actually the second best performing over the last year. As we can see here, RITM up 62%. Now, when we extend that to the last 5 years, we actually see ABR the best performing, up 68%. Not the greatest over the last 5 years, so we can see the bulk of the best performance has literally been over the last 12 months. Nonetheless, do bear in mind that past performance, whether good, whether bad, it is not an indicator of the future performance. Now, we do want to point out a very bullish signal. As always, when insiders buy, we believe it's for one reason, and that they believe the share price will grow. As we can see, William C. Green, the director, did buy over 10,000 shares not too long ago, the 18th of March, at a cost of $132,000. Now, it isn't the largest amount. Typically, we like to see $500,000 or more. Nonetheless, a fairly bullish sign, and we can see since then the price is up 2.47%. Now we move on to essentially looking at institutional ownership, 57.25%, with 87 million worth of sales by these institutions over the last 12 months. During the same period, a lot more buying, over 600 million over the same period as well, which is important to note. So that is very positive for shareholders or potential shareholders. And we can see every single quarter, notably Q2, however, with a large purchase, more inflows than outflows. And the latest quarter, the same is to be said. So very bullish, lots of positive signs for this business so far. Now, before we take a look at some of the metrics, just to point out a few things from their latest presentation, or investor presentation, we should say. We want to point out firstly that their distributable earnings, 62 cents per share, very solid, and this gives their payout of 68%, which we will come on to shortly. They've had 11 straight years of dividend growth, so that is very nice to note. And they do like to highlight the fact that is 40% dividend growth in those last 13 quarters. They've also increased their book value by 45% over the last 3 years. And what we want to point out is that whilst this is a mortgage REIT, so an M REIT, the focus is multifamily as well as single homes. So just a few facts to know about this company. We'll also talk about some of their repurchases, as over a net position there is actually more issuing of shares than those share buybacks. So let's take a look at the dividend safety first. Just to note, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, click on that pinned comment below to sign up. Now, dividend safety score, we have 50 here. It does look to be borderline safe. Market cap is 2.5 billion. It is a mid-cap company. And when we take a look at those recessionary metrics, so the last recession, they did in fact cut the dividend. We see below average growth in terms of recession sales, no surprises there. And we see they significantly underperform the S&P, negative 96 versus negative 55. Again, no surprises given this is a mortgage REIT. Now, dividend growth, very strong, very positive. We do see 9% over the last 4 years, significantly above 4%. And this is a very positive sign. Not only is the yield double digits, but also they are increasing those dividends by more than inflation. Over the last 5 years, very positive at 10 years. However, we do see over the last 20 years on average, they are struggling to keep up in line with inflation. But then again, you could argue that if they are paying you a very handsome yield, that wouldn't be the biggest issue you would have. We can also see they have been increasing those dividends for the last 11 years, and during the recession they paid no dividend and restarted it in 2011. So taking a look at dividend yield theory, we can get a sense here of undervaluation. Remember, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. So we have a massive signal here, as well as on the forward PE 7.8, it is lower than the 5-year rolling of 9.3. When we compare it to the financial sector PE, it is also lower. Bear in mind, with these undervaluation signals, we don't look at any of them in isolation, and we will conclude towards the end. Now, in terms of looking at the payout ratios, typically on the channel, we do like to focus on the free cash flow, a lot more volatile with these REITs, so we draw your attention to the earnings. Now, we like to look at below 95% for mortgage REITs. What we can see over the long term, it has been decreasing from the very high position of 148%. Over the last 4 years, including 2023, around 70 to 76%, which looks healthy. Just bear in mind, based on the expectation of 2024, it does look to be fairly high at 101%. That is what we would consider to be a red flag indicator, as it means the company is paying out more in dividends than they're generating in earnings. But again, something just to keep an eye on as their 2023 and 2024 quarter-on-quarter results do come out. In terms of the earnings per share, well, it has been growing very strongly over the last 10 years. Very impressive for a company that does pay out a very high dividend. But do bear in mind, 2024, they are expecting a drop to $1.71. In terms of the earnings per share growth as well, you can see here the percentage very strong for a large portion of the last 10 years. But do note 2023, it was just 1%. And we can see here the sales growth in percentage format. In terms of shares outstanding, whilst they do some share buybacks and share repurchase, we can see the net position would be a share dilution, having increased those shares outstanding from 50.4 million in 2014 to 219 in 2023. And as we can see here, if you do want to understand why, they do have high payout ratios and therefore they do have to borrow money and issue shares to grow their business. Numerically as well, we can see they have rapidly increased their top line from 93 billion or million to 719 million in 2023. ROE, then we can see 10% or more is what the ideal scenario is, and it is essentially what this company is bringing to the table. The last 2 years at 13% looking very healthy as well. Now, typically on the channel, we would look at the operating margin as we can see on the left, and we would also draw your attention to the net debt to EBITDA. But again, for REITs and MREITs in particular, EBITDA isn't meaningful, as essentially interest is a core component of their revenue and their expenses. So let's jump into the valuation of this very high yielding company that does look to be severely undervalued. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. The first model we're looking at today is the multiples valuation model. Companies in a similar sector and size that we analyze in terms of their performance over the last 5 years. We have their P multiple, we have the average multiplied by the EPS of ABR to get an intrinsic value showing $25 and therefore our first undervaluation signal. But do bear in mind we're not looking at any of these models in isolation, and we will conclude towards the end. We then have the dividend discount model with the growth rate over the last few years. Average growth rate very high at 8.63%. We do note it has started to slow down with the more recent year at 2.4%. We have gone a lot more conservative at 1%. And based on this gives an intrinsic value of $24.82. Again, another undervaluation signal. We then move on to the DCF model with the free cash flow year on year. And forward looking, we have pretty much gone in line with the average over the last 10 years. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get our intrinsic value with 3 undervaluation signals. So the intrinsic value in today's episode is the average of these 3 models. And as always, don't forget you can grab a copy of this model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on the pinned comment below. As always, we do start off our margin of safety with 10%, and we do use that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, it is a buy up to $20, and we keep going till it's near the current trading price. And we can see for today's episode for ABR, it does command a very healthy and strong margin of safety of 40%. Now, there will be lots of risks with mortgage REITs, as you will be aware of, so do take that into account. Some people will be looking for a higher margin of safety, even higher than 40%. Some people will be satisfied with that rate. In terms of Wall Street and their forecast over the next 12 months, well, they have a price target of $15.67, so they see upside of 18%. So not only with this essential mortgage REIT are you locking in a very high yield, it is one that also increases its dividend above inflation. On top of that, Wall Street are forecasting some very nice upside over the next 12 months, and we do believe, based on our estimates and judgments, that there is a healthy margin of safety. As always, though, do let us know your thoughts in the comments below, whether this has been on your radar, maybe you have bought this before and sold it and looking to re-enter, or maybe you're not bullish on mortgage REITs as a whole. As always, let us know if you enjoyed today's episode. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next one.